Hello and welcome back to the ROI podcast, the podcast that's obsessed with many things, but particularly the art and science of return on investment. And it's been too long since I caught up with my good friend, the professor of value. He's got the Bitcoin in his background now. He's looking young, fresh. He's drinking mate. I think that's taken about five
There we
years off
go.
your appearance at least, Stephen. And today we're going to talk about a few different things where the topics will take us, particularly what trades he's seeing on the horizon in terms of macro and meso setup. Uh, the American might be looking outside of the US. Very un-American, but I like it. We're going to talk about one stock that really made me pay attention to this guy's work. It's up over 100% or nearly 100% year to date. 6 months it's up. It's nearly a triple. It's something we're going to delve into, guys. If you're not already subscribed to the Unemployed Value Degen, the links will be in the description. And while you're at it, if you like what we do, hit the like button, hit the subscribe button, and it really helps with the algorithm. My sir, we're going to dive straight into it today. Finance of America, this small, at the time, $40 million cap company that you discovered. Have other people discovered it? And are they too late to get on the bandwagon? I know that's what they're going to ask me next.
It is starting to get some traction, but it's still only I think a $200 million market cap. So
192,
is it now 192?
according to my yes, according to my ticker, yes.
Oh, okay. So and also it's been super volatile. It jumped up to $27, back to $18, to $24, to $18. So it's been very volatile. They've um they've had 5 quarters of sequential improvement. Well, this is what's hard about it. Their accounting is so all over the place because they use mortgage REIT accounting. So Finance of America companies, it's the market leader in reverse mortgages. And because of that, they use mortgage REIT accounting, which means you kind of have to take them at their adjusted figures because there's so much in the mark to market valuation on their massive book of mortgages outstanding. The mark to market changes of the outstanding mortgages are so much larger than their operating income every quarter. You can only go by adjusted numbers. This is what happened with Jackson Financial. So Jackson Financial was one of my better quality names that I found. I think I bought it when it was about $30 a share. Now it's $100 a share. Um, they're one of the market leaders in variable annuities. And it was the same thing. Every quarter, the losses or gains on their derivative hedges were more than operations. So you can dig into it as much as you want, but you just have to see, do I trust management with their adjusted figures, adjusted income figures for this quarter? But if you believe their adjusted income figures, this is the 5th quarter of improvement, and it was the 1st quarter of positive net income, but they also had about $175 million gain to book value because on my paywalled article on the Substack, I talk about their residuals that they're accumulating. And even though they haven't started receiving cash on it yet, they do get to market that when the value grows. And just out of the blue, there was about $175 million last quarter. And this was a 50 million market cap company when I found it. And there's, surprise, here's $175 million. And that's just the beginning because I think they've got about $1 billion coming to them over the next 3 or 4 years.
Yeah, and that's what I wanted to touch on. So we've spoken about it before in the past. That $1 billion, let's talk about the mechanics of it showing up in the income statement. That's, I think, what is confusing to most people. So they've written a certain amount of business. You've identified that as roughly a billion over the next, if I remember correctly, 3 to 5 years. What is that going to look like in terms of when it's realized on the quarterly, semi, and annual income statements?
So of their book of business, these reverse mortgages. So there's these elderly people that want to supplement their retirement income. They take out a home equity line of credit, and this company has a home equity line of credit on their house and will send them a check every month. So Finance of America Companies is accumulating equity on the house,
Mhm.
and the elderly couple or the widow is receiving a check in the mail. Well, Finance of America Companies needs to have money to send them, so they take that home equity and they sell it as a mortgage-backed security. which everyone is terrified of after the global financial crisis. But it's the way they structure it is they do 5-year bonds, 5-year mortgage-backed securities, callable after 3 years, because just in case the interest rate moves against them, they want to be able to, hit the do-over button and issue them again. Now, this company is paying out to the mortgage-backed securities market a fixed coupon on these mortgage-backed securities they've issued in order to get the money to send the old couple a check in the mail. But the equity that's accumulating on their house is accumulating at the rate of a floating rate mortgage. And a floating rate mortgage has usually a little bit of a higher interest rate than a 5-year fixed mortgage-backed security. So Finance of America Companies is catching the spread between the floating rate mortgage and the 5-year mortgage-backed security. Now,
and that spread is going to be their income, right? What's going to happen when it comes time to either call in the mortgage or roll it over? What are the mechanics of that?
Yeah, so it's only when the mortgage-backed securities mature, in which case Finance of America Companies is going to issue a new 5-year mortgage-backed security to pay off the old one that matures. And when that happens, that spread that's been accumulating for the last 5 years, they capture that value. So that's going to show up in their income when they retire the old mortgage-backed security and they issue the new one. Now, the first time that's going to happen is going to be in April of 2025. But I don't know how much is for. I think they have about 25 mortgage-backed securities outstanding, and they're going to be coming in over the next 3-4 years, and until this new, when they reissue the new one. The reason why I'm following this one batch is because I wouldn't have been smart enough to seek out this company on its own, but after I turned over rocks and discovered it makes sense. Not only have we had the Fed raising interest rates, but they inverted the yield curve. For the longest time, and the most inverted yield curve has ever been in history. Well, the floating rate mortgage is based off of the overnight rate. And the 5-year mortgage-backed security is based off of the 5-year treasury. So with the inverted yield curve, the equity, the home equity that Finance of America Companies is receiving, well, with the inverted yield curve, that went way up. And then what they're paying in the mortgage-backed securities for what they had issued, these are ones that they had issued from before interest rates rose. So those, the average coupon that they're paying is about, I think, 3.25%. When that matures and they have to issue them again, 5-year treasuries have gone up, but the overnight rate just went up so much more. So there was a 2 or 3 year period where the spread between the floating rate mortgage and the 5-year mortgage-backed security was 4.8%. So there's a $50 million company capturing 4.8% on $7 billion. So they were making $350 million a year for 2.5, 3 years. And this has been ongoing the whole time. Nobody knows about it. It doesn't show up anywhere except the very first mark-to-market value of it showed up in $175 million in book value last quarter. But the first cash coming in, the first net income from this is going to be in April 2025. But it's going to be 2 or 3 years of just increased book value, increased net income. And then on top of that, just the business is recovering. So on top of it, the volumes are increasing. These reverse mortgages should be a product that is really needed because you've had, when interest rates went up, bonds got crushed, and any elderly people that had their retirement savings in balanced mutual funds, well, if you are in a target date mutual fund and you're in your 70s and you're 70% bonds, that part of your retirement savings gets crushed. And then the price of everything is up 40%. So whatever income you were expecting doesn't go as far. So the number of senior citizens in the US that need this service is probably through the roof because of the inflation. And if inflation stays sustained, it'll just get worse. So the market demand for the product should be there. So the volumes this company could do, they did, so 2024, they did about $2 billion in volume. Senior citizens in the US have $14 trillion of home equity. And that's just to do $2 billion of reverse mortgage volume on a $14 trillion asset base. And they're the market leader with 37% market share. this thing could really become popular and blow up. Um, so anyway, I'm super excited. I'm buying as much as I can, as much as I can tolerate until I become over concentrated. Pretty much every week, every other week, I'm just buying more.
Yeah, seems to be a solid plan so far. I would like to talk about your end game with this. What do you think ultimately this could be worth in let's just call it a 3 to 5 to 7 year time frame? And what are your plans? You made a video on how you plan to scale out of this thing. And then what are the risks? What happens? What would upset this company's operating model in terms of capturing that spread? If we're heading into a ravaging inflationary environment, is that a good thing or is it a bad thing for them? Or are they heavily at the mercy of that yield curve that you mentioned?
Yeah, well, even if so, there were two things I was looking for. I had a position, I had even a reasonably large position, but I was waiting for two things for to say really, okay, all in, put all my poker chips on the table. And the first was when they could operationally get back to operating net income positive, because they were bleeding cash for a while. They might have had their residual value growing, but operationally they were bleeding cash. They pay themselves a commission every time they underwrite a new mortgage to keep the lights on and pay salaries. And volumes had really fallen off a cliff after the banking crisis. So these volumes fell off a cliff for COVID too. This is a very hard sale to make, to convince a 70-year-old widow that she should give up her home equity. It's just not an easy transaction. And so they're typically sold in person in the bank branch from a financial advisor in your bank branch. And it's not an easy thing to do. Well, during COVID, you couldn't meet anybody in person. So there goes that whole sales channel. And then when there was that banking panic, when Silicon Valley Investment Bank and First Republic went under, then who wants to get into a big complicated transaction with the bank? So they've had years of really low volumes. And the volumes now are reaccelerating. They did 2 billion in volume in 2024, and they're guiding toward 2.7 billion in volume for 2025. So management says things are coming back, things are getting good. And then they cut costs. They got about $80 million a year of costs out of their system. And so they flipped to net income positive. And the second thing that I really want to see is when they make money, what are they going to do with it? Because I typically look for companies that have insider buying, that have some strong capitalist to try and make sure that things are going all right and that management doesn't run away with the place. And this company doesn't really have that, although they do have, oh, I forget the guy's name, but his his family office is called like the Omega Fund, and he's always battling with Elizabeth Warren on television. But there is a large shareholder who I really enjoy. He was actually even a few quarters ago, he was on an earnings call trying to give management hell for how the progress was going. But I forget his name. So that there is a large shareholder to try and give him hell, but it's none of the C-suite executives are buying stock in the thing, and which is normal. 95% of C-suite executives never do an insider buy because just in their mind, they're employees and they do their job. But if the company goes bankrupt, it's no skin off their nose. So I look for C-suite executives that think of themselves like capitalists and buy stock in the company. This doesn't have that. So I want to see what happens when they finally have cash in hand. How do they spend it? That's my last reservation is, are these guys going to blow a bunch of money on bad acquisitions? Or are they going to return capital to shareholders? But I'm pretty optimistic about the way that they cut costs and got back to net income positive. So far, so good.
Yeah. A few comments on exactly what you're mentioning with the inflection into net income. I mean, these guys they were negative March quarter, negative June quarter, and then they flipped into operating and net income positive to 210 and 84 million, respectively, according to what I'm looking at. Down the income statement, earnings per share $8.50, and then if anyone looks at a price chart, you can see at around September when I presume, reported that was what the stock price was trading at. It was about $8, so they were at a PE of 1, incredibly. And you're saying that we're expecting a lot of these, although they may be lumpy cash flows, there's plenty more where that came from. Over to the ownership side of things, we've got Blackstone Technical. Brian Libman, as an individual investor, owns 11.4% of the company. Omega Advisors, 10.5, 11% that you mentioned. So very
Yeah.
concentrated bets.
Yeah, that Omega Advisors, the guy whose family office that is, I can't, his name is slipping my mind, but there is Leon Cooperman. So
Leon Cooper.
if you ever watched CNBC and see Leon Cooperman come on, he's entertaining to watch. But I was just kind of fanboying when he came on the earnings call and asked a bunch of questions and gave hell to the management team. I was like, I know that guy. But to be actively on earnings calls giving management hell when you're in your 70s and 80s, that's what I want to be doing. It's my new hero.
Yeah. Okay. So interesting. And ultimately, what are you looking to underwrite this investment for? When are you looking to scale out? That was probably a better question.
So yeah, taking profit. I'm actually, the reason why I'm buying more now is so that I have so much in it that when I take profits, it doesn't I don't have to sell any of my initial, $5 a share cost basis shares, because that it's going to be too emotionally painful for me to do. But
Okay. So you're at the point of, as my uncle Rick would say, you're at the point of no concern with the stock.
I wouldn't say no. I mean, something could happen, right? There could be something new that really surprises me. The big threat that I'm looking at now would be if management's capital allocation policy is bad. If I find out that it doesn't matter that whether they're going to make $1 billion because they're just going to blow it, that would definitely limit my position size, and I'd look to sell some. But as long as they spend money prudently, then I don't really mind how concentrated a position this becomes in my portfolio. As far as what I'm going to underwrite it for, so if we have sustained inflation, and the trueflation numbers are back, I think 2.7%. So if we have sustained inflation, and these elderly people in the US, their home equity keeps going up. I mean, home prices go up an average of 5% a year. So when I first looked at this company, senior citizens in the US had 13 trillion in home equity. Now they have 14 trillion in home equity. So the number of the baby boomers are largest demographic. They're retiring. So the number of baby boomers that could need this service, I mean, it could really just explode. So I put together a spreadsheet trying to model what their volumes would be. But on a little bit of marketing, their volumes could easily surprise everybody. But on a 5% growth rate on volumes off of their 2.7 billion that they projected to next year, I think I had a 3 billion market cap for 2029. So that's yeah, that's not including if they spent all the money they make in the meantime on any sort of return to capital to shareholders. So they do have some convertible debt outstanding. So, but if when they make money, they do some share buybacks, they retire some convertible debt, things like that. This thing, it's already been a four bagger, but it could easily be I did some metrics based on price to sales, price to cash flow, price to net income, price to earnings. It could be another six bagger, it could be another 15 bagger. It really depends on how fast the business grows, if that niche industry really takes off, if their market dominant position with 37% market share holds. There are some fintech companies getting into this space because I think people are starting to realize that this reverse mortgage product is going to be needed and it's going to be growing. But the question is, this 70-year-old woman in her home, is she going to be using a fintech product, or is she going to go to, the established player in the industry? Who's going to take market share if it really takes off? All that sort of stuff. So whether it's a six bagger or a 15 bagger from here over the next 5 years, I don't know. But I think it's going to be really good.
Okay. You're the finance professor and really math quant guy. I'm a Neanderthal. I'm going to ask you to help me with this calculation. If I spend however much your Substack is per month, and I make a return of 16, 20x, is that a good deal for me?
I actually had and I even sent a message to the guy telling him thank you, and he hasn't responded. So maybe he's an introvert. But in Substack, you can become a founding member, and you can pay the annual fee plus any amount and get this tag founding member. And so I have it at $5 a month or $50 a year. I had a guy in Canada pay $51 to be a found. He paid $1 extra to become a founding member. But I had a guy just last week from Switzerland. He paid 800 Swiss francs, which was a pretty nice hello for the week. So I have to assume that he's enjoyed the four-bagger that this has been already since I wrote about it, because otherwise, why is he sending me 800 Swiss francs off Stripe? So I probably need to figure out how to make a digital tip jar, because I only charge $5 a month for the Substack.
They
But
exist. They exist. And you can do it with crypto too. You can have people send you crypto tips.
okay, yeah, I finally came around to crypto. My sustained inflation strategy is, oil, gold, and land, all the things that did better in the 70s. And as that started digesting over time, well, we've had the shale revolution, so oil is not as slow to bring online anymore. And we also don't have the situation in the 70s where we were so much of an energy importer. So even though oil outperformed in the 70s, it might not be the huge inflation beneficiary. And when it comes to gold, which has been great because central banks have been buying it, but young retail investors don't care about that stuff. And I was a former finance university teacher, and all the young people are into crypto. So in that fight over what is going to be money in this inflationary environment, I finally had to come around and realize that I needed to have at least some, 1-2% of my portfolio with a crypto exposure. So I did write about three crypto companies on my Substack, but it took me a while to get there, and then I got a lot of a guff on Twitter. Oh, signs at the top. The unemployed value Degen is talking about Twitter. Like this is
I
it.
can
It's
see the
gonna
pain.
crash
I can
from
see the
here.
pain in your face as you're talking me through. It's okay, buddy. It's okay. Come here. You're
I've
welcome.
spent
Join the club.
so much time in college studying money that I was slow to come around, but hopefully I'm not a stereotypical boomer who hears about it on Facebook and it's really signs at the top. Maybe I'm not early to the party, but hopefully I'm not too late.
I think, given the fact that, well, particularly with Bitcoin, this is designed scarcity protocol. Murray Stahl would say it's the most conservative investment that there is in the face of profligate fiscal and monetary policy. So, my friend, wrapping this part of the conversation up, the key question is, why am I going to buy this instead of buying more Landbridge, Texas Pacific, more royalties?
Yeah, well,
Or
Texas
is
Pacific
FOA
Land was just
kind of a
inducted into the
royalty,
S&P
kind of a royalty?
500. Um, I've seen different papers on this in academics. So there's these the dogs of the Dow, or delistings when something leaves an index. Typically, if something has a little bit of euphoria under it, things will get added to the S&P 500 when they're a little toppy, and things will get delisted from the S&P 500 when they're kind of undervalued. So typically, things that get kicked out of the S&P 500 usually have a few good years afterwards, and things that get added to the S&P 500, they kind of underperform for a bit. So I don't know if Texas Pacific Land is kind of overshot. It might have, it might not, because there's really good odds that the data center build out will focus on data centers where the natural gas is being drilled. So, I mean, for Texas Pacific Land and Landbridge could be an AI story, and it really could go to the moon. I'm not against it. Yeah, you're definitely royalty pilled. That's all I can say. So I listen to Murray Stahl. I like his earnings calls, especially because he sounds so much like Alan Alda from MASH, and I grew up watching MASH, and so I just love listening to Murray Stahl's quarterly conference calls. And yeah, he could be right. I could just buy Landbridge and stop worrying about everything. But then, like you said a couple weeks ago, well, then what would I do with my time?
Yeah, well, that's there's always boat trips off the coast of Panama, but outside of that, I can't help you. Uh, let's talk about, speaking of international waters, what's going on with the US dollar? Everyone, Trump was, well, both candidates were campaigning basically on a campaign of we're going to weaken the US dollar. That's where we're
Yeah.
at in the world. Trump gets into office and the DXY goes on a tear. How do you see things with regards to the dollar? Is this a short-term run-up before a crash? And how are we going to position ourselves if that is indeed the case?
Well, let me go ahead and set my yerba mate down for a moment and see, share my screen. So this is not the first time that this is not the first time that so you have the election and interest rates. This is the 10-year Treasury, and I drew a couple of technical analysis lines on there. I don't know for a fact this is what's going to happen, but I think this is what the market professionals believe is going to happen. Mm-hmm. That the 10-year treasury is going to have ups and downs, but we're moving in this downward channel. And it's not just because the United States is cutting interest rates, but globally, central banks on average are cutting interest rates. This is an increase in global liquidity. This is a global cutting cycle, and China stimulating. But for interest rates to go up on the first Fed cut, and for interest rates to go up on the election news, a lot of people were taking that to mean that the Fed is making a policy mistake. Oh, they can't cut because inflation is still high. But I don't think that's dominantly what's happening. I think what happened is there's been 2 other times when the Fed cut and interest rates rose for the 10-year treasury. And that was 1995 and 1999. And the idea is people believed that the chance of recession just fell. So if you want to fly into bonds for safety and the chance of recession just fell, well, now you can sell your bonds. You can sell your recession insurance, and that's going to make the 10-year treasury go up. So I think the way to interpret why the treasury went up on the Fed funds rate getting cut is that people are pricing out a recession. That it seems like recession is not on the medium-term horizon, that the narrative is finally becoming, hey, the Fed has the economy's back. There's no recession that anybody can see coming, so we can go ahead and sell our bonds. That happened in 1995. It happened in 1999. And that could be what's happening now, is that the market's saying no recession chance. So, but in the meantime, so it looks to me like, and this might not be what happens, right? It could be you get halfway through 2025 and interest rates maybe rise and break out of this channel. It's entirely possible. But I think most market participants think that we've got, at least a year, maybe 2 years of staying in this channel where interest rates go up and down, but we have lower highs and lower lows. And overall, the 10-year treasury will be falling for a couple of years. Now,
okay,
what's that? What that has done? Okay, so now other central banks are cutting also, but the United States, when we rose interest rates first, and we rose interest rates faster. Now that we're cutting last and we're cutting slower. So on a relative basis, U.S. interest rates are higher than Europe and Canada and a couple other places. So money flows to where the returns are better. And what this has led to is, let me pull up this next chart. So this is, and I drew a different channel here. This is the dollar index. And I drew a different channel here because it's kind of been bouncing around this sideways channel. And when interest rates rose on the Fed cutting cycle, the dollar has just been aggressively strengthening, which has made all of the emerging market stocks sell off and crash. And I put out a trade idea to my Substack subscribers, a Black Friday trade idea. Just whatever you do, go out and buy something international today, because there's very good odds that the dollar index is going to bounce around this sideways channel. And we've got a couple months of a weakening dollar. But in the long term, I don't know, because you have Trump with the JD Vance going out there saying that they're going to raise blue collar wages. And historically, the way you do that is you competitively devalue to benefit exports. Now, the United States having cheap energy and being behind on the cutting cycle and having inflation sort of preventing the Fed from cutting more aggressively than anybody else, I don't know if we actually can achieve a weak dollar if that's the plan. And we had Scott Bessent, the new Fed Treasury, or the new Secretary of Treasury nominee. He came out in the Financial Times and say we're not pursuing a weak dollar policy. Now, politicians might be lying; they're good at that. But there's a possibility that the U.S. is going to pursue a weak dollar policy. There's also a possibility they're going to pursue a strong dollar policy. And this one, I've been following John Mearsheimer and some of the real politic takes on the Ukraine war and how we're going from a unipolar world of one superpower to a multipolar world of the US versus China. Well, John Mearsheimer said something that I thought was interesting, is that in a unipolar world, you can the single superpower can be kind of ambivalent about regional powers. So when China was not a concern, the United States didn't really worry about the European Union, because whatever, let them be strong in Europe, that's fine, we have the whole world. But in a multipolar world, the two multipoles, from a realpolitik perspective, they have to weaken their the people in their sphere of influence, because they're not allowed to flirt with the other power, right? So the European Union was awfully chummy with China, selling them all of their luxury handbags and things like that. The strong dollar policy, that this strengthening dollar, these high interest rates, have been devastating for everybody who's issued US dollar bonds and who can't print dollars. And if the goal of US financial policy is to weaken everybody in our sphere of influence so that they can't flirt with China, like, you know, in Peru, China's building this huge deep water port system to, make inroads for their Silk Road. But the United States, we've had this very ancient doctrine that North and South America, that's US only. Everybody else is not allowed to participate here. So if our goal is to weaken Latin America and to weaken Europe so that the things in our sphere of influence cannot, under any circumstances, play around with China, including Australia, including Canada and the UK, the United States with their 30-year fixed mortgages, and the rest of the Europe and the UK and Canada and Australia with 5-year floating rate mortgages, well, the longer we have high interest rates, the more all those countries are brought to their knees and told, hey, if you want any relief from this pain, you need to stay away from China. So if the realpolitik of it is that the United States cannot tolerate a Europe that flirts with China, then we might have a strong dollar and high interest rates, because anybody who's issued US dollar debt and can't print dollars is going to be in so much pain. And that includes all of the super majors in South America, companies like Vale, companies that have issued US dollar debt and can't print dollars. But it also affects the whole euro dollar bond market in Europe. So there's this massive, and this is getting a little out there in the academic land, but in the 1970s, I can't remember if it was Ferrari or Lamborghini, but one of the Italian muscle car companies wanted to enter the United States in the early 70s. And they came to Wall Street, and Wall Street was like, we don't know who you are. So the interest rate they were offered in New York for issuing bonds in the US to open over here, they were too high. And just on a whim, they said, you know what? I wonder how many dollars there are in London. So they went to London and they said, hey, can we raise dollars in London? We would like to issue, I can't remember if it was Lamborghini or Ferrari. Let's say it was Lamborghini. Let's issue some Lamborghini bonds in London, but not bonds that are British pound bonds, US dollar bonds in London. So when you have debt in a country that's not in that country's currency, it's called a euro dollar. Not the euro, the European Union's currency, but a euro dollar, which is US dollar denominated
outside of US territories
in Europe. Well, this market is huge. And this is a part of the US dollar's reserve currency status, the international exchange currency status. The US dollar as being this global important currency, is that there is this multi-trillion dollar, and nobody knows how big it is because the rules on this, right? The whole banking system in every country is based on what you do in that country's currency. If you do something in Switzerland in dollars, the government's like, whatever, we don't care. So there's not real good data on how many of these things out there are. But if dollars are hard to come by and your Lamborghini bonds in London mature in dollars, you have to buy dollars no matter what the price is. So the strong dollar policy is going to be very painful for, large European companies, large South American companies, South American sovereigns, anybody who's issued US dollar denominated debt, and that's coming due. And some of these are 30-year bonds. So if John Mearsheimer is right that in a multipolar world, we have to weaken everybody in our sphere of influence, then the dollar could stay strong. So even though I have this dollar index in this sideways channel, and it could bounce around this channel, and if that happens, you want to be buying international stocks for a nice 2-3 month swing trade, there's a very real possibility for the next couple of years, you might break out of this channel to the upside and have a strong dollar, which is just going to cause so much pain in Latin America and Europe and Australia, Canada, and the UK. And that could be intentional, because how dare they flirt with China in a multipolar world? They have to be squarely within our sphere of influence. So this is something really to watch over the next couple of years, whether we have a weak dollar or a strong dollar. It's gonna determine a lot of which stock markets outperform, which companies to buy.
Makes perfect sense. One thing I'd like to ask you about, that all I followed perfectly. The issue is the US budget deficit and the fiscal situation. So how much could they really allow these rates to rise before the US becomes basically Zimbabwe? The interest is higher than the tax receipts, and we get to that kind of situation. Then they'll start to QE, find an excuse for QE. The interest rates can rise, but what you've got to do is keep the QE happening so that you can service the rising interest on the sovereign debt in the US. So is it really in the US's interest slash ability to be able to create a stronger dollar when they have to service their own dollar debt?
So there's been a lot of Trump trades going on. A lot of people, and I had written about, so when the Biden Trump debate happened, I wrote about Geo Group, that real estate investment trust for prisons. And I said, everybody's buying this thing, but last Trump term, he had a remain in Mexico policy. If you do remain in Mexico, then these prisons aren't going to be full. Why is everybody buying this stock? Now, since that time, Geo Group's price has doubled. So the market believes it's a Trump trade. The price has doubled, and Trump's not even in office yet. So there's a lot of Trump trades that are moving the market that may or may not be true, but in the meantime, you can make an awful lot of money on them. I don't think anybody knows what Trump's term is going to be like. I mean, for one thing, you've got Elon Musk, who is, probably the most incredible entrepreneur in capitalist history. I mean, he's blowing Thomas Edison's record out of the water, things like that. He says he's going to cut $2 trillion from the U.S. federal budget. Now, as a kind of cynical person, my baseline is nothing ever happens. But, this guy has just reduced the cost of getting a payload into outer space by like 10, 20, 100 times. He's pretty incredible at things he sets out his mind to do. So even though I would usually say nothing ever happens, and I don't want to be Charlie Brown when Lucy pulls the football away, but I think nobody really knows what the Trump administration is going to look like now that it's not Trump with the conservative Republicans. This is Trump with Silicon Valley. And Silicon Valley, they felt really betrayed by the Democrats. These are people that just want to build. They just want to do their thing. They want to get to Mars. They want to make the internet. They want to make things happen. And then you had the Democrats, go hardcore Marxist and put in Lena Khan at the FTC and just ban all these mergers and acquisitions and start saying, we're going to break your companies apart. And you had Elizabeth Warren and Gary Gensler on crypto saying, no, you're not allowed to save in cryptocurrencies. And Silicon Valley said, screw this. And they walked away from the Democratic Party. And I mean, that might be as historical of a shift as we've got this famous moment in the 1890s about the gold and silver currency, where the famous speech was, they're going to crucify us on a cross of gold. This could be as momentous to the political system as that cross of gold speech, because you're talking about a major shift of a huge power base moving away from the Democratic Party over a currency issue. So this is a fascinating subject. When you have Silicon Valley saying these regulatory agencies, where we have hundreds of thousands of federal employees that do things like, and the most amazing one was in California, where the bureaucratic entity said, we're going to deny Elon Musk the right to launch his rockets on this airbase because of his political alignment. And they said it in the public minutes. Like, that is just shocking, that they would, that they're supposed to lie about this stuff and not tell us what they're doing. They're saying we're actively going to target our political opponents. So thank you for your honesty. But I don't think anybody knows what this Trump administration is going to look like if Musk can actually cut a couple $1 trillion of federal spending.
Sure,
Another
but
aspect of this, oh, go ahead.
maybe he does. Let's say he does. 2025 is the year next year where I believe it's close to a third, maybe more than a third of the short-term paper in the US needs to be rolled over. Now, this was written, Janet Yellen wrote this at like 2.2 something average interest rate. No matter, Elon can do whatever he wants. That's got to be rewritten now at that chart you mentioned. Let's call it four and change. That's double the interest rate on a pretty big base. Realistically, how much, regardless of how much efficiency Elon can or cannot achieve in his Doge department, is that really going to change the big picture in terms of the US fiscal situation?
So,
Because that's what's going to drive monetary policy at the end of the day.
so it hurts me to argue along these lines because I would rather have a responsible government that isn't rewarded for its own bad behavior. When you look at the US debt, you probably need to overlook the US debt that's held in the Fed's balance sheet because that debt has been monetized, it's gone, it's never coming back. That's $8 trillion. Also, even though the Federal Reserve was initially created as a private entity to make profits for JP Morgan, in the 1930s, there was this greenbacker movement that got a law passed, and they weren't financially savvy. They just was more of a nationalistic thing. They passed a law in the 30s that said the Fed's profits has to be remitted to the Treasury. And Janet Yellen just pioneered the system where, okay, instead of issuing 10-year, 30-year bonds, let's just do everything overnight and use the Fed funds rate. So, okay, the US government pays the Federal Reserve interest on this overnight rate, but then the Federal Reserve has to turn around and remit the profits back to the Treasury.
Okay.
So, where normally you would have to issue a 10-year bond, and then if the Fed buys it, it's monetized into the system and you have inflation. Well, now this can all be done with the overnight rates, where it can be immediately monetized, which thank you, Janet Yellen, for pioneering this magic money hyperinflation machine. So even though the 10-year Treasury is somewhat high, and it would be very painful if this was all rolled over into long-term debt and would cause interest rates to rise. If the new Treasury Secretary keeps doing everything in the overnight rate, and the overnight rate, even without yield curve control, the overnight rate is the one the Fed controls. People think that we're on our way to a 3% overnight rate. So there's no guarantee the Treasury will refinance this into long-term paper. They might just keep everything in the overnight rate and have the profits remitted back to the Treasury, which is, it's Weimar Republic type stuff, but it's also possibly what they're going to do. So the idea that we're going to have a bunch of 30-year bonds at 5% and then that's going to bankrupt the system might not happen because they might just keep it all in the overnight rate.
I see. I see. Well, I'm glad I asked you that question. That wasn't high on my consideration. I didn't think we were going full Weimar, Gideon Gono-esque Zimbabwe. But at the end of the day, if that's the case, if what you're saying is true and correct, I revert to my usual status quo, which is why buy Petrobras, Ecopetrol companies I still own a little bit of, and why don't I just buy more damn land, gold, and land with royalties? Because it's going to show up
Yeah, so
hyperinflationary in commodities, or it's going to be a weak dollar. Either way, life's pretty good.
so you still have the artificial intelligence revolution, which we've been spending a lot of money on, but it hasn't demonstrated a lot of productivity gains yet. But there's been some, and I'm not a high tech person. This is a little bit outside of my wheelhouse, but there have
Don't
been
lie,
some
Stephen.
promising
Those
signs.
headphones tell us all we need to know, mate.
These were from I have a write up on Dollar Tree, Dollar General, Five Below. These were from Five Below, $5.55. I had been going to buy more and more expensive headphones, and they keep on breaking. So just the connection between the wire and the headphones, it's just cheaply connected and they break. So I was buying $30 headphones, $50 headphones. They all keep breaking. I buy these $5 headphones and I bought two pair for the next time they break, and they've never broken. So my $5.55 headphones from Five Below have been doing fantastic for me.
Facts.
But as far as back to the tech and the artificial intelligence revolution, the productivity gains. So Trump, when he was asked about this deficit, are you going to reduce the debt? And he says, yeah. He's kind of like he kind of danced around the issue about whether the
He
debt will
went
ever be
full he went
repaid.
full private equity presentation to say you grow your way out, you leverage, and then all of a sudden your leverage is back and it's your
Yeah.
IRR is up.
So if
I've seen real estate guys
deregulation,
before. Yeah.
yeah, if I mean, there's no reason why even an advanced economy, which is focusing on new technology, there's no reason why we can't grow GDP at 5%, except for regulation. And especially when if we have capital from all over the world flowing into our capital markets to invest here, and we
Yes.
have brain power from all over the world fleeing pernicious regimes to be entrepreneurs here, there's no reason why we can't hit 5% GDP growth with a huge deregulation wave. So it's not just about Elon Musk cutting $2 trillion out of the federal spending. It's also about a massive deregulation wave and actually getting to that GDP growth rate. And if we do hit even a 3.5%, 4% real GDP growth rate, I mean, what a fantastic time to be alive. I don't think we've ever lived through that sort of a world here in advanced economies where it was just, I mean, things would be amazing. So they
Absolutely.
might be increasing the money supply through the overnight rate, but we might be growing the economy faster than that, or at least at a similar speed to that. So I'm not going to say it can't be done. I believe we're going to be having a sustained high inflation, but that sustained high inflation could be 3-4%. It doesn't have to be 12%. It doesn't have to be Weimar Germany. So again, um, I
You
have
guys,
the baseline.
what about we outside the empire, my friend? Our currency.
Oh, I mean,
For
if
me in
if
the third world down here in Australia, it's not going to be pretty.
yeah, well, you guys with your floating rate mortgages that didn't have this 30-year fixed system, it's going to be a tough time. Plus, you have all the Chinese immigrants buying up all the houses and driving property values up. So I think there's going to be a lot of push to get to somewhere where the economy is good. Look at what's happening in Portugal and Spain. I mean, the low birth rates combined with this government imposed pension system just means every young person in Portugal wants to get the hell out of the
Diaspora.
country.
Diaspora.
So you see them all showing up in Argentina and showing up in places where things are good and life is better. So that exacerbates the brain drain where entrepreneurs want to come to the United States and get things done.
100%. So again, my friend, we come back to okay, maybe you use your floating rate short-term paper, Janet Yellen's idea. AI miracle does happen. Well, if the AI miracle happens, you know what that's going to need, Stephen? It's going to need copious amounts of natural gas, data centers out in the middle of the Permian, and a lot of water. So why would we buy anything other than companies that own land strategically with water easements, telegraphs, lots of natural gas?
Yeah, so I'm not going to try and poke a hole in your land bridge Texas specific land thesis, except that at some point everything gets a little overdone and reverts to the mean. I'm a value degen. I want to find the things that are undervalued and catch that swing up. And I don't know if land bridge and Texas specific land are there anymore. But if you just want to buy something for the next 10 years, then I wouldn't yuck on your yum. It sounds like a pretty reasonable thing to do.
Yeah, in addition to if we do get your strong dollar idea happening, um, my real estate in Argentina is going to be very, very nice. That peak, that chart you showed just when the dollar was super high before it broke out again, I mean, that was an amazing time to be traveling abroad. It was just unbelievable if you had
Yeah.
US dollar denominated accounts, paying you options, premiums, dividends, interest on your brokerage account would get you a fantastic lifestyle. So I can see everything that you're mentioning in terms of the migration issues around the world, and it could
it,
well.
it could go the other way. We could also pursue a weak dollar. This is definitely, and this is something that we have to watch. And one of the things is, I don't think anybody knows what's going to happen. You've got all these Trump trades that the market's moving, but I don't know if really this is how the world is going to look. So coal has been a strong Trump trade, but a lot of the coal plants being decommissioned are happening on the state level. So like Minnesota is a strong blue state. They're decommissioning coal plants, and the some of the cities that those coal plants serve are in South Dakota, and they're like, "Yo, what the heck are you guys doing, shutting our power off?" So
Mm.
the blue states can still shut down coal, and the blue states can still build out solar power. So I think
Here's
there's a lot
my
of Trump trades that could be wrong.
here's my thing with coal. Coal thesis, fantastic. Practically making that work in investment terms, not so easy. I think that there are easier ways to go about it. Everyone's on the met coal train, which is wonderful. Yarn coal, super cheap, 100 years of thermal reserves. I like that. Whitehaven, okay, and Warrior, and then you've got your Met CB ticker for Ramaco's. It's got that royalty and rare earth upside. A couple of percent here and there for me. I don't think I'll be going back to the days of writing out big coal positions to do the whole covered call thing, because it's just like you saw what Peabody did. I don't know what your reaction to that deal is, but I think I think coal is not as easy. The thesis is easy. Making money from it is what matters to me, and I
Yeah.
don't think it's as easy as people think.
Well, Peabody is a great example of a company that my fear for Finance of America companies is you have this
Yes,
management team that they seem competent, they seem technically skilled in coal,
but no
and they do
skin in the
things
game.
that maybe aren't shareholder friendly. So Peabody Energy does this big acquisition. The market doesn't like it, although it did just hit its 200-day moving average. So it might be a buy right this moment, but it's not $29 a share anymore also. So, that's why I try to find a company where insiders are buying and where the management team is going to act like a capitalist and not like a manager. Um,
Well, one such company, if I may be so rude as to interrupt you, which is a Trump trade, is Profrac. And I'm very well out of this company, so thank you for bringing it onto my radar. I wasn't as keen with the onshore trades, but this and NorAm drilling, I like. Absolutely rocketing through its 200-day moving average at $9 it closed. There's a long way on this thing to go. What's the risk this thing gets taken out
yeah,
privately? And where that meme where the kid looks at the balloon and someone, just as he's about to grab the balloon, he takes him away.
yeah, that's always been the biggest risk for Profrac Holdings is that so that the generation running it's two cousins. The CEO and the president are cousins. Their fathers or brothers, the Wilkes brothers, they founded a oil services company, grew it, sold it for $3 billion, and that generation owns 75% of the company. So there's always been this huge risk that why not just take your ball and go home? Why not just take the company private? The reason why you want to stay public is as a public company, you have better access to the debt markets, you have better access to the equity markets, you can do more acquisitions. And Profrac Holdings was all about the roll up of building this large company. But that risk is there that if they get to the size they want to get to, they could just take their ball and go home and keep their cash flows. Especially if under this ESG regime that we were under for so many years, um, professional money managers are not allowed to invest in the space, that they have these rules in their portfolio that they can't touch anything fossil fuel related. But as far as oil field services, so the onshore, you have the drilling rigs, and there are companies that do onshore drilling rigs. But you also have the frac trucks, and the frac trucks, those are the ones that are cracking the rock, pumping in water mixed with sand and some kind of a chemical thickening agent, and the frac trucks are what ACDC Profrac Holdings focuses on. And there's only about 250 of those fleets. I could be wrong about this, but my guess is, and that number is down because we've been in this soft period for energy. But another thing going on is, and I don't know, predicting the markets is hard enough, but I follow a couple of people that are meteorologists on Twitter. I mean, actually bona fide meteorologists, and allegedly, if you can trust anything that the meteorologists say, after 2 years of a warmer than average winter, we might have a colder than average winter. So you might have natural gas demand in the US, natural gas demand everywhere for heating your homes, for generating electricity, might be strong this winter. And so not just on the drill baby drill fracking increasing, but and also the export terminals for natural gas for the US being built out. But you might actually have a cold winter on top of that. And ACDC Profrac Holdings would be a huge beneficiary. And maybe one of my most painful trades so far has been Vermilion Energy, which is this Canadian E&P
Forget it,
company.
mate. Forget it.
But they're drilling for natural gas in Europe, and they're able to sell natural gas at Dutch TTF prices. And Dutch
And they
TTF.
will be subject to like this magical 80% royalty that comes out of nowhere.
So one of the things about that, and they have a lawsuit to try and get some of that money back.
Good luck
So
with that.
good luck with it. But Vermilion Energy, their offshore platform in Ireland, it's a zero royalty platform. So back when the West was sane and they wanted to have energy independence, the government of Ireland signed this contract. It's a zero royalty platform. Now, whether their lawsuit to claw back the windfall profits tax comes or not and happens in their favor, who knows? I think the lawsuit has some merit. The European Union sent out a missive to all its member nations in the middle of last year and said essentially what the U.S. discovered in the 1970s. So in the 1970s, the U.S. did windfall profits taxes, and exactly when you need more supply to come online, it deterred supply growth. And so the European Union said, okay, we're sorry, this was a mistake. Please, all member nations, don't do any windfall taxes again. Now, obviously, if you have some ridiculous socialist government in the UK, they could do it anyway. So you have the official stance of the European Union is no more windfall taxes. That was not cool. We don't want to suppress supply exactly when we need supply. You have a zero royalty platform offshore Ireland, and you have potentially a cold winter. Vermilion Energy is not my favorite thing, but at the time I didn't have another oil and gas E&P where there was insider buying, where the management team had the right incentive alignment. Since then, I have maybe found some other things I like better, but I kind of want to see how Vermilion Energy is going to play out this winter.
Look, I agree with what you're saying substantially, and I totally get it. And my friend Shabam Garg from White Tundra, every year he just buys out of the money calls on Vermilion because eventually his idea is that this is just going to pay off ridiculously. I don't know. I'm just emotionally fragile after years in the market, and I don't need that. I don't need that stress. What any other? We can talk onshore, we can talk offshore, because offshore is on the nose apparently at the moment, which for me is, I'm loving it. I can buy up some more discounts. But what about onshore? Any of the onshore guys in the US that you like in the Permian? My favorite onshore are the royalty companies because it's all going to take place on their land. But anyway, onshore versus offshore, what's your take?
Well, so there's lots of slices in the energy space. And as far as the producers themselves, I really do like the longer life assets because it's one thing to be right, the thing is cheap, but it's another thing to be right on the timing. And if you're doing the short life of the fracking companies, I think you have to be right on the timing too, because the wells are only going for a couple of years. And I'm not smart enough to be right on the timing. So I don't want to own any producers that are in shale. Now, there were a couple long life, slow decline drilling things. One was Sandridge Energy, and that I was hoping that the large ownership stake by Carl Icahn would put some discipline on their capital allocation policy. But then Carl got in trouble, and all they did was special dividends to send Carl home the money. So when you have, they said we're going to do M&A, and the price of everything is so cheap, and they have cash in their war chest, and they don't buy anything. So that was a huge frustration because Sandridge Energy is a slow decline asset. You have the strong capitalist in charge, but that strong capitalist had a short report out against them and needed the cash sent back to them. So they do the worst capital allocation policy possible, which is special dividends to bail out Uncle Carl. That was a huge disappointment because a lot of things are right for them on paper. They have slow decline assets. They have a strong capitalist in control. It's just that it didn't work.
Producing.
The producing space is hard. That's why I like the services space. I like pairing Profrac Holdings with Transocean. Then I got my offshore services. I got my onshore services. And the offshore services, that might be a Trump trade that hasn't gotten any traction yet. Because when Trump says drill, baby, drill, that means the Gulf of Mexico too. Absolutely. And the Gulf of Mexico, sorry, go ahead.
No. I'm agreeing with you. I think Profrac is a perfect example of people get the drilling, drill, baby, drill is going to be good for Profrac. Well, it's going to be even better for a lot of these offshore guys because the break evens are even better now than onshore in many cases. And there are really only a handful of players left that can do what needs to be done, that can operate in these offshore basins to get the oil that Trump wants to keep the energy prices down.
exactly. And so the Gulf of Mexico has been drilled for so long. A lot of the proven reserves remaining are at high pressure. And compared to Valaris and Noble, Transocean is the one that has the 20,000 psi technology. So this is a case where the technology leadership matters a little bit. So if you just have one new rig deployed in the Gulf of Mexico, it's probably got to be a Transocean rig, and that's huge for them. So drill baby drill, I think, affects offshore because of the Gulf of Mexico, and I think that affects Transocean more than it would affect Valaris and Noble. I could be wrong about that, but the market hasn't moved. The market hasn't priced that at all. So the market's pricing in Profrac, but it's not pricing in Transocean. Another thing is, so Trump promised to get your energy costs cut in half. That's one thing I have no idea how he would actually be able to deliver on.
Well,
But
we can
people that
deduce this. So we can say what levers does he have? He can go to MBS, has a better relationship than Biden does with MBS. That's not difficult. And MBS can increase output. Let's just say, well, what is that going to mean for Aramco and the JV with Valaris? Well, I'm going to go out there on a limb and say that more of the jackups in the Arabian Peninsula are going to be put to work at higher rates. Then we go onshore. We've covered that thesis. There are really only a couple of levers for him to pull, and they seem to be the big ones.
Well, I think a lot of people are saying this is going to mean lower oil prices. But I think if you look at the ability for Trump to reenact sanctions and take Venezuela and Iran's barrels off the market, you might have a swing where, you know, output could fall with those barrels coming off the market, or output could stay flat, but the production shifts, some to OPEC and some to the US. But I think the first thing that Trump is going to do, even though everybody's predicting lower oil prices, if you take Venezuela and Iran's barrels off the market, that's going to do a bunch of stuff. For one thing is, so I did a trade alert recently for tanker companies. Tankers have been suppressed with, so Biden has been allowing Iran to sanctions bust, right? They're selling their oil to China, which uses, it puts tankers on the market because the Iranian tankers aren't being used for floating storage. They're running oil to Malaysia. And then Malaysia, who has very little drilling, is suddenly an oil exporter, go figure, right? So it's kind of amazing to watch. But reenacting sanctions on Iran would take those tankers off the market because now they're floating storage again. So there's fewer tankers on the market. And on top of that, the trade routes are longer. So the ton miles go up because there's fewer tankers doing longer trips. So Trump might be great for oil tankers. And then another aspect of this is if he does deregulate, if he does implement some sort of tax reform. So the left has been really bad talking about Trump tax cuts, saying all these corporations don't pay taxes. Part of it is the level of taxes. But the one thing that Trump did that was very, very powerful was he allowed extremely accelerated depreciation. So if you have extremely accelerated depreciation, companies that have been holding off on spending CapEx, if you can depreciate so much of that in the first year, let's spend it all now.
Exactly.
So the chance of having an increase in economic activity driving up for the demand for oil at the same time as you take Venezuela and Iran off the market, you might have oil prices go up pretty considerably at first under Trump. And even though shale is fast, it's not that fast. So you could have demand outstrip supply. Yeah. So this is so Trump is promising to lower energy prices. Now, what he might do is he might go to some of these grid operators that are driving up everybody's prices to subsidize windmills and just wreak havoc there and get US electricity prices down. But maybe the oil prices, I don't know if they're going to fall because we're already at oil prices that are in the supply destruction zone. So if you're already at supply destruction, how can you lower oil prices much below that without he doesn't want to bankrupt US industries. He wants US industries profitable. So I think there's a chance that the demand for oil could go up because of the accelerated depreciation and deploying all this capital and all this activity at the same time as Iran and Venezuela's oil barrels are off the market. So everybody's predicting oil to fall. And maybe they're right. They could be right about that. But it could go the other way. You could have oil prices finally rise into 2025. That's not my base case. That's not what I'm saying is definitely going to happen. But I would not be surprised. I'm not selling any of my oil companies, no matter how painful they've been for the last 2 years. I'm not selling any right now.
What do you think about my idea? I think we're going to have maybe a $70 to $80 range would be a base case. If you allow me a little bit extra, I'll say 65 to 85 over the next few years. I think everyone's reasonably happy there. No one's, well, except the Canadians, no one's really hurting too much. Offshore is a different kettle of fish, and that these are longer term projects that are they're not so much dictated on the spot price for oil. They're long term contracts, and they only need to kind of be in the 70s for most of these projects to get the green light. What's your base case for oil over the next 2 to 3?
So there's a really good chart for oil prices, and it has if you want me to nerd out on you, they call it a bimodal distribution.
Yes,
But it's
please.
you know what a two-humped camel looks like, a dromedary camel.
Yes.
So the oil price chart over time, if you just make this heat map of where oil prices are, it looks like this two-humped camel. And one hump is the supply destruction range. The other hump is the demand destruction range. And the range you're talking about, the $70 oil, that's in the supply destruction range. But sometimes we're in the demand destruction range. And the demand destruction range is more like $120, $130 oil. Now, maybe shale oil can come online so fast that we never see demand destruction prices again. But if we get into that second hump of the camel, or we're on that right side of the graph, or if we're on demand destruction, that's $120, $130, $140 oil. We could easily get there so China is stimulating, right? China has had a rough time the last few years as they're digesting the malinvestment from their massive apartment build out. The people that are negative on China say, oh, they stopped embracing capitalism. It's a different kettle of fish now that the communists are in control. Maybe, maybe not. I think it's possible that China could be off to the races at the same time as the US is off to the races. If China, India, and the US are all firing on all cylinders at the same time, then I don't think the supply of oil could come online fast enough to handle that. I could be wrong, but you got to be prepared for the possibility that we spend a year or two in the demand destruction part of the curve and not the supply destruction part of the curve.
Yeah, and I know I sound like a broken record, but when we hit demand destruction, we don't stay there for very long, right? So you're gonna have this little spike and come back, and either way, you get access to that upside via these royalty interests, and then you don't have anywhere near so much of the downside if we get into the supply destruction phase. What about the cheapest molecule on the planet in terms of energy? US natural gas, specifically Waha, but not many people talk about that. They always refer to Henry Hub. 2025 is supposedly the year where global gas prices start to converge. We had a few false starts over the last few years, a lot of people calling for it, but then you had Freeport go offline. US natural gas, I think, has tested the patience of everyone. There are safer ways to play it. How do you see that playing out in 2025? We've got Cheniere, we've got Freeport supposedly coming back on and adding billions of cubic feet more demand. New Fortress, heaven help us, gets their act together and they start exporting a lot. What's your take on Henry Hub over the end of 2025, let's say, if some of these things that we're mentioning start to play out?
This is one of the reasons why I'm so grateful for being unemployed, getting fired by my old university, is I can listen to so many earnings calls. Profrac Holdings' last earnings call, activity was picking up in the Haynesville Basin, and the Haynesville is a pure natural gas basin. And things like that tell me, okay, the people that know the most
Natural gas, family issues, they go together. What's your take on natural gas over the
yeah,
next 1 to 2?
we got cut out because of power interruption.
Because
Exactly
not
what
enough
data
natural
centers
gas being used
are
in the
not
US.
allowed to have. So, which is why they're going to build all these data centers in the Permian or who knows, Pennsylvania, wherever the natural gas is, because
Permian,
you
mate.
can't have power disruptions with artificial intelligence data centers.
Nope.
And the batteries, you don't want them catching on fire either. So The natural gas markets, you've got all these export terminals coming online. You have all this LNG ship capacity coming online. But the natural gas market is chunky because of the long-term contracts. You've got so many parts of the industry in 15-year contracts.
Mhm.
So my students at the university, when the avian flu hit, they were asking me, hey, one grocery store near my house, eggs are $5 a dozen. The other grocery store, they're $2 a dozen. What the heck is going on? And I had to kind of explain to them, well, some grocery stores engage in long-term contracts and fix the price, and some grocery stores operate on the spot price. So there's definitely going to be a lot more volume in natural gas, but I don't know if it means all the prices will come together because it depends who's got the long-term contracts and who's operating spot. And sometimes it'll be up, sometimes it's going to be down. There's one shipping company, which I won't touch because it's even too degenerate for me. And it's Zim Holdings, because what they don't own the ships, right?
No,
They'll do a long-term lease
lease.
and then try and make money in the spot market, which if you're right, you make tons of money. And if you're wrong, you go bankrupt. And so I would rather have the leverage in my own account, but then buy a conservative company that owns the ships with very little debt. But the whole shipping space has been taken out to the woodshed, and it's getting tempting to get back in. Even Cool Company does LNG carrier ships. They've got two on spot, and the other, I think, eight or nine on long-term contracts. So the company is got a lot of locked-in profits coming to them. It's trading at a discount. So I like Cool Company a lot. But I think it's going to be like the eggs during avian flu in the US, where some grocery stores it's $5 a dozen and some grocery stores it's $2 a dozen. Volumes are going to go up for natural gas, but I don't think we're at the point where the price is going to come together because it's still going to be a chunky market. Um, and who knows if winter is going to be cold, if summer is going to be hot, where the infrastructure is. I think it's going to be an interesting time for natural gas, but it's not the cheapest energy source per molecule. That is uranium, right? That's the thing that is just so powerful and so um, and the market is having this sort of manic depressive bipolar. Some days the market thinks that uranium is the future, and some days the market thinks that the build out is going to be 10 years away, and it's really all over the place. It's going to be interesting to see because you have some of these Silicon Valley tech founders, which now apparently are in control, right? Some people say the Republicans won the election, some people say Trump won the election, and some people say Silicon Valley won the election. So when you have Sam Altman with a small SMR, small modular reactor company, you've got Bill Gates with a small modular reactor company. It's going to be interesting to see that when the regulators are out of the way, how fast those things could come online, because the base case is this takes 20 years and we're not going to see it anytime soon. But that's only because of the regulators, right? That's only because you've got somebody from the federal government saying, I don't like what you did, tear it down and start over again, which happened in the Vogtle plant in Georgia like 5 or 6 times. So if the regulators are taken out of the way for nuclear, it'll be interesting to see how fast Silicon Valley could ramp this stuff up in a world where nobody's holding them back.
So I agree with you, and you're obviously correct in terms of uranium. I'm jumping straight ahead to say, well, how do I make money off these themes? What's easiest? It's tricky with uranium. It's very, very tricky, other than obviously when you get in at a discount to production costs, but those days are behind us at the moment with the Sprott vehicle. Then there's really only one royalty in the space. So that's an interesting call option out into the future.
I have a paywalled stock. I wasn't planning on giving away any secrets today, but you're going to get it out of me anyway. So my paywalled uranium stock is Centrus Energy, and the symbol is LEU. And uranium, you have the miners. Then the next step after mining, you have conversion, where they convert it to uranium hexafluoride. And right now, there's no easy way to do that. But with an activist investor trying to split up Honeywell, there might become a way to invest in uranium conversion, because Honeywell has the only private uranium conversion facility. And if they get split up, it'll be interesting to see if that becomes investable. The step after conversion is enrichment. And there's two uranium enrichment companies. One is getting a lot of traction on Twitter. It's ASP Isotopes. And they're doing not just uranium, they're doing a lot of things like silicon 28, which is going to be important for the semiconductor industry. There's a lot of very rare isotopes, which some of it comes out as a byproduct of industry. And even though it's very rare and very valuable, there's enough byproduct. But as some of these really high-tech manufacturing processes ramp up, somebody's going to have to go out and actually manufacture these very, very rare isotopes. And so ASB Isotopes is in that space, but they're very early stage. But the company I wrote about is called Centrus Energy, and the symbol is LEU. And I wrote about it when it was about $40 a share, and it's jumped up to 120. It's back down to 90, something like that. They're a private uranium enrichment company, and they're using the same old centrifuge technology for uranium enrichment, not like ASP Isotopes. But what makes them so unique is, so the United States, we have these nuclear non-proliferation treaties. And part of these nuclear non-proliferation treaties, we don't want plutonium going to every country in the world. We don't want every country in the world having access to make bombs that could end all life. So we have these pretty ironclad non-proliferation treaties, which when the US government buys fuel for its Navy, it can only do that from a US domiciled, US owned, US controlled technology. Now, the US Navy hasn't had to buy uranium for 40 years. Wrap your head around how efficient of a fuel source uranium is. We made so much of it in the 60s that the Navy hasn't had to buy any for 40 years. We've just been operating off of a stockpile. I mean, imagine how much diesel or how much natural gas you would have to store to run your aircraft carriers on them for 40 years. But with uranium, that was just a trivial feat because the thing is just so unimaginably energy dense.
No doubt, no question. But that's not always good for making money off the thing.
It's not always good for making money off of it, but because the US government can only buy uranium from a US controlled uranium enrichment company, and the other uranium enrichment companies, there's France, there's Japan, and there's Russia. So we need a US uranium enrichment company. And the company that has been in the wings to do this is Centrus Energy. It was a former US government agency that in the wave of privatization was spun off as a private company. And they understand government contracts, and they're in the wings to be the uranium enrichment company that can supply the Department of Defense and all US government needs, but then also to supply uranium enrichment for civilian reactors. And so this is the size of that market by about 2030 is just for the US government's needs, it's $1 billion a year, give or take. And they can only buy it from a US company. And this company, Centrus Energy, in order to build them up, in order to give them enough money to spend on the capex to build out their capacity, the Department of Energy made 3 government contracts, 3 tender offers for people to come in and compete over this slosh fund of money. Now, allegedly anybody can compete for it, but the money is designed to build up an American company. So the French and the Japanese submitted their tender offers, and it was an okay contract, and they won a part of it. But it's like here's $1 billion. Everybody who wins gets 2 million, and then as you perform, we're going to allocate more funds to you, but we don't know how much they are. But are they going to allocate more funds to the French and the Japanese, or are they going to allocate more funds to the private American company who's going to become the new defense contractor? So imagine you can get in at the ground floor of Raytheon before they become this huge defense contractor selling all this stuff to the US. So that's Centrus Energy. Now, there are some problems because before they have their enrichment online, they were still importing from Russia. So Russia is kind of, even though Kazakhstan is the #1 place for uranium mining, Russia was the #1 place for uranium enrichment. And arguably they might have, when people talk about dumping, there's a lot of kind of unreasonable, economically ignorant takes on dumping, saying, oh, they're selling stuff at below their cost. Well, then they would go bankrupt. Dumping in the sense that they're selling stuff below their cost is very, very rare. But in the case of these national security arenas with China and the rare earth elements and Russia with the enriched uranium, it really might be the case that they were selling it below their cost. Whereas you'll get these, ignoramuses in economics say like, oh, Netflix is selling below their, no, they're not, they're profitable. How could Netflix be selling below their cost to crush competition when they're profitable, right? This is just a bad take. But uranium enrichment in Russia and Chinese rare earth refinement might really be strategically below cost to try and control the supply chain. So Centrus Energy has these import agreements to buy enriched uranium from Russia to then deliver it to US civil electricity generation. And with all of the animosity between the Biden administration, the Ukraine war, and Russia, and these, sanctions back and forth, there are some concerns that Centrus Energy won't be able to fulfill their contracts. They're being cut off from the Russian supply, and there's this delay before they can ramp up the uranium enrichment. And there is a risk there, but I'm curious to see what the world looks like after Trump gets in and wants to cement himself in the history books as the great deal maker. Now, I don't
Well,
think.
I've seen the news feed that Zelensky's publicly announced that he's willing to cede some territory if it means the end to the conflict. So presumably end of the conflict, end of the sanctions.
Well, I don't know if the end of the conflict will be end of the sanctions on Russia. So it's one thing to end the Ukraine war, which would be fantastic for world peace. Not that they would ever give Trump the World Peace Prize. Right? That only goes to Obama, who redesigned the drone double tap, right, where we can also drop a drone on the ambulance crews that's trying to rescue the people that we just bombed with a drone. Now that's who gets the Nobel Peace Prize. But I think it's highly likely Trump will be able to negotiate an end of the Ukraine war, but I don't know if that, I have strong doubts that Europe is going to reintegrate economically with Russia, or if Russia has now been chased entirely into China's sphere, which is the biggest strategic mistake probably the United States has ever made. Because we could have had Russia, who thinks of itself as a Western country, right? They think of themselves as inheritors of Western culture. They could have been in the US's sphere against China, and instead we kind of pushed them into China's arms. Well, in order to keep Europe from flirting with China, we might want a weaker Europe, which would not be reintegrated with Russia. So you might see a world where Russia's in the Chinese sphere, which they don't even like. They would rather be in the Western sphere. I mean, Putin asked Clinton to join NATO, and Clinton did not allow that to happen. Bill Clinton in the 90s. So this was probably the biggest U.S. strategic mistake, but I think we might see very quickly an end to the Ukraine war, but it might not mean economic reintegration with Russia, which might mean Centrus Energy doesn't get their enriched uranium from Russia. So there might be some busted contracts. There might be some force majeure. We'll have to see what happens in the immediate term with Centrus Energy. There might be some bad news, but over a 10-year time frame, this is the birth of a defense contracting monopoly that I have strong doubts anybody will be able to compete with them effectively, because Centrus Energy has a $4.8 billion backlog going out to the year 2040. So these power companies, they want to secure a uranium supply for 15, 20 years. And so if you're a new uranium enrichment company like ASP Isotopes, who doesn't even have production yet, are you going to get a 10-year contract compared to somebody who's already doing it, or the company that already has a $4.8 billion backlog will get that contract instead? So
you're saying $4.8 billion backlog on a market cap currently about 1.3. Enterprise value is the same. There's no real net debt on this company. What's the risk here? Is it technological disruption that we haven't thought about? What's going on?
So ASP Isotopes has a technology where they can separate the uranium-235 from the uranium-238 with a laser, as opposed to spinning it in a centrifuge. What this would allow that would allow ASP Isotopes to do is, because it's more efficient, they could get enriched uranium out of the tailings. So because we've been doing uranium since the 60s, we have stockpiles of what we call depleted uranium, but it still has fissile material in it, which ASP Isotopes will be able to extract. That's a bigger threat to uranium miners than it is to Centrus Energy, because if you can generate enriched uranium from the 60-year stockpile of tailings, then
on your supply.
Yeah. So, but I think the demand for uranium is going to increase enough that it still won't be bad to be a miner. But in ASP Isotopes presentation, they talk about how many kilowatt hours it takes to do a enrichment work unit.
Right.
And it's like 40 kilowatt hours as opposed to Centrus Energy, which is 50 kilowatt hours. I don't think the energy cost is such a big gap that ASP Isotopes will displace Centrus Energy. But it is a competing enrichment company in the space, but is very early stage. But Centrus Energy, there is going to be the risk of competition, but they have a huge head start. There is the risk of broken contracts from Russian trade sanctions, but we'll have to really see the details of how all that plays out, especially with Trump in office and trying to bring down electricity costs. I don't think Trump is going to allow the nuclear utilities to run out of fuel. So we'll have to see how that works, but there is real risk there. But I think you're looking at a 10-year time span to when Centrus Energy becomes a Department of Defense contracting monopoly. That's one possibility. We'll also have to see one aspect of how Elon Musk wants to get $2 trillion out of government spending. And JD Vance talked about this in some of the interviews he did. Is kind of this bargain between Republicans and Silicon Valley, where they're going to make the government contracting process more transparent and allow Silicon Valley to compete with it. Companies like Anduril and Palantir, that all of the old stodgy companies like Lockheed Martin and Raytheon, maybe the gravy train is over for them because the young tech startups can compete openly on those contracts. They're not, corrupt, custom tailored contracts that only one company is eligible to bid on. That this $1 trillion a year defense budget, maybe the bargain is we're able to cut $200 billion a year out of it, but then Silicon Valley can compete over the rest. That might be what the future Pentagon spending looks like under a Elon Musk, JD Vance, Peter Thiel administration. So Centrus Energy does have some risk of not becoming a government contracting monopoly, but there's pretty good odds that they become the sole supplier to the US government and a pretty decent supplier to civilian electricity enriched uranium. So that's an exciting company, and it's more than doubled since I wrote about it. But yeah, the risk is the Russian enriched supply and broken contracts and force majeure and all that stuff. But the company has no debt. They've got a $4.8 billion backlog. And also, there's different grades of enriched uranium. There's the 5% enriched, which the civilian nuclear power uses. There's 15-ish% enriched, which the SMR, the small modulars reactors, use. And then there's 35% enriched, which the Navy uses. And so Centrus Energy is building towards being able to supply the Navy. And on the way there, they can supply the small modular reactors that Bill Gates wants and Sam Altman wants and Silicon Valley wants. So that's not the monopoly they're going for. They're going for the Navy monopoly. But on the way, there's this huge market that they can compete with. And $2 billion of their $4.8 billion backlog is with these small modular reactor companies. And there was a short report recently against ASP Isotopes saying, hey, that's not a real backlog. This is not a real purchase agreement, which is true. So the small modular reactor companies are too small and too far away from production to sign a real purchase order. So they have these non-binding MOUs, non-binding memorandums of understanding. Both Centrus Energy and ASP Isotopes have those, but Centrus Energy has $2 billion worth of them, and ASP Isotopes has one with, I think, Bill Gates's TerraPower company. So that's just the nature of this sort of frontier marketplace where the companies are too small to really sign binding purchase orders. But the MOU says if both sides hit certain milestones, then it's going to become a binding purchase order. So, but then 2.8 billion of Centrus Energy's backlog is the civilian power demand, real hard fixed backlog. But that's at risk of being disrupted if they can't deliver because of the Russian supply disruption. So there's risk here, but the setup is really nice.
I agree. Fascinating. That's why I enjoy reading your work and talking to you guys. If you want to get access to these things before they double, triple, quadruple, quintuple in some cases, make sure you check out the link that will be in the description to the man's Substack. Thank you very much for joining me once again. Guys, take care, do your own due diligence, and I look forward to catching up with you in another episode of the ROI podcast. Take care.